Have you ever pondered over the question of how companies raise money for their growth? Well, it's not as simple as asking for a loan from a bank or finding a wealthy investor. One of the most popular methods is through something called an initial public offering, or IPO. Imagine you've baked a large pie and you want to share it with others. You slice it up and sell each piece to different people. In essence, that's what a company does when it goes public through an IPO. The pie represents the company, and each piece or slice is a share of that company. An IPO is the first time that a company sells its shares to the public. Before an IPO, a company is considered private. With a limited number of shareholders, these private companies are not subject to the same regulations as public companies. However, once a company goes public, it must answer to its new shareholders and comply with the strict regulations of the Securities and Exchange Commission. But why would a company choose to go public? Well, there are several reasons. Primarily, an IPO helps to raise capital for the company. This influx of cash can be used for various purposes, such as funding research and development, paying off debts, or even facilitating acquisitions of other companies. Additionally, going public also increases a company's visibility and credibility in the market, which can be a valuable tool for attracting new customers and quality employees. Finally, an IPO can also provide a company's original owners and early investors with an opportunity to cash out some or all of their stake, reaping the rewards of their early faith and investment in the company. But it's not all sunshine and roses. The IPO process can be costly and time-consuming. It involves hiring investment bankers, accountants, and lawyers. The company also has to create a prospectus, a detailed document that includes everything a potential investor would need to know about the company. Moreover, going public also means that a company's financials are under the microscope, and it must be accountable to its shareholders. This level of scrutiny can often lead to increased pressure on the company's management and board to perform well. To wrap up, an initial public offering, or IPO, is a significant event in a company's life. It offers the potential for substantial financial gain, but it also comes with increased responsibility and scrutiny. It's a high-stakes game of risk and reward, where the outcome can either catapult a company to new heights or lead it down a challenging path. So, the next time you hear about a company planning to go public, you'll know exactly what's at stake. It's not just about raising capital. It's about sharing a piece of the pie and embarking on a journey that can change the company's trajectory forever.